Welcome to the live stream, stock investors, stock traders. It is a pretty amazing week. It's been a week where we've seen stock prices drop after very good earnings from companies, which has been amazing. Part of the reasoning that the market is expensive is exactly what we're witnessing, which is a company announces great earnings and stocks sell off. This today, as an example, NVIDIA, we covered it in detail on a watch party yesterday. Daryl co hosted with me, and we saw it. NVIDIA was up 5%. We started the day today. NVIDIA was up nicely, and the market as a whole was up nicely. We were up on the S&P well over 1%. Then somebody decided, you know what, we are selling. And the turnaround amounted to intraday 3.35. That number really grabs my attention. It tells me that there are a lot of sellers with the intent to sell and stay away. They just want to cash out. And I think the market's going to go lower. Now, that's not completely bad news. Lower stock prices mean I get to buy great businesses at a lower price. That in itself is good. It's just rough because your portfolio takes a hit. And speaking for myself, it was a pretty bad number today. It's been a bad number really since October 28th. I think we're down about 5%. So it isn't horrible yet, but from October 28th to where we're at now on the S&P, we're down 5.11%. Halfway to a correction. And of course, some stocks will be more volatile than the S&P, most definitely. And those stocks have gone down quite a bit from their highs. Let's take a look at some of the notable names, starting with NVIDIA. NVIDIA had terrific earnings. I just, thought their earnings were phenomenal. But from the recent high on October 29th to where we're at now, NVIDIA is down 12.75. That's a little rough. Let's take a look at our friends at Amazon. Amazon's been a kind of a sick puppy. And from the recent high to where we're at now, down 14.5. And I will gladly buy more shares of Amazon, by the way. But it's a rough period in the stock market. And I think we're probably going to go towards a 10% overall correction, probably get to 7 or 8 and start to rally again. That's my guess. It's an educated guess at best. So that's the market we're in. Now, as we saw earlier in the year, these sell-offs sometimes are a gift, really disguised, among a lot of bad news. Back here on these live streams, on investor calls, we covered this. We treated this as an opportunity. And guess what? It was a fantastic opportunity. And we took advantage of it. I took advantage of it with the stocks that I own. I did quite well during that period. So now that we find ourselves with another correction brewing, and frankly, I think it's due. Stock prices were just really expensive, and they just continue to go higher. It was pretty amazing that stock market didn't care about valuations. It just kept going higher. So now I guess we do care about valuations. I guess investors are thinking twice about, hey, maybe the stock's way too high. A PE of 50 or 80 is much too high. Yeah, I would agree with that. Let's get back down to the 20s. Unless you're a really high growth company, you can operate in the 30s, maybe in the 40s, but it just seems so many stocks are easily mid 30s, 40s, 50s, 60s. And I just shake my head and think that's expensive. So that's where we're at. It's an opportunity. The glass is half full for me. I'm going to take advantage of it. I've been buying stocks. I've been sharing that with super investors. I've been sharing that on the Discord. And it's good to see others are taking advantage of this because I think it is an opportunity. Over the long term, stocks will yield a better performance than cash, most definitely, and most any other asset class. Crypto has been getting hammered. And the recent high, I think we're going to catch it. We're going to catch it. No, I think we need to go 6 months. So the recent high was at $124,310 per coin. We are down 30% since the high on Bitcoin. And that's over a month and a half. That's what we call volatility. There's no support there. There's nothing to compare to Bitcoin, and it's really been tanking. I own Bitcoin. I own like 1.3 Bitcoin and would like to see it go higher. Now, I have bought my Bitcoin starting in 2017, so I'm still at a nice gain, but it's still pretty rough waters to see Bitcoin go down 29.86. I was in the gym today thinking to myself, maybe I should buy some more Bitcoin. And maybe I should. The price is pretty darn attractive. I'm going to give that some thought. Maybe I might buy a little more Bitcoin. We shall see. All right. So things are selling off, but it's really go time for investors that are long term that want good prices on stocks. So let me pause there. Let me turn my attention to members and everybody on the chat. To begin with, Smith & Wesson became a YouTube member of my channel. Thank you so much. And he upgraded overnight. Thanks so much. I would really like to get your email address. You can do that by emailing me at Victor H Investing. And I put my email address on the chat. You email me, I get you hooked up with access to a shared folder. You're going to get access to all the valuations, and you're going to get access to member only calls where you can ask questions about the tools that I use that you get access to. We can build valuations on that member call and talk on a web conference. You can ask questions, everything you need there. You're going to get access to the Discord, the membership level you have. I'm going to share my trades with you actively throughout the week. And then I'll give you a summary video over the weekends, kind of showing where I'm going with my investments. I share my entire portfolio with you so you understand how I'm managing my portfolio. And when you have time, we can do a 30-minute call. So you get me your email address, get you all set up. Thank you so much. We've had a good number of new members. Same goes to you. Please email me. I want you to get as much value as possible from me being a paid member. And one thing that's come up, stock analysis, I've used them for a long time. And more recently, they started to work with YouTubers, and they reached out to me and they wanted to work with me, which I gladly said I'd like to, because I actually pay for the service. I find the website to be uncluttered with a bunch of advertisements like Yahoo Finance. It's just, coming at me with 500 ads, it seems. Instead, I could just concentrate on making great sound analysis and making great investments. So they have a program, and you can get signed up with my code and I would get credit. I'd appreciate that. But they reached out to me and said, hey, we'd like to run a promotion on X. So if you go on X and put in your best price target or your best price prediction for NVIDIA, and it has to be before Monday. I think it's get your prediction in by 12 a.m. Eastern on Sunday night. And I hope you win. And if you win, you're going to get 3 months free of stock analysis. Of course, you're going to get the pride of knowing that you got the closest to the pin on NVIDIA. Looks like we've got Herdo. Herdo, how you doing, man? It is good to see you online. It has been a tough week. But these tough weeks, I hope we look back 4 months later and go, man, we made some good money on some of these stocks that went down irrationally. They went down more than they should have. They're good companies. And I'm thinking of companies just to spell one out. I think Meta is priced really well. Meta's growing great. They're doing great, great growth, great profit. They're getting shellacked because they're spending too much money on that darn data center. But maybe they can fix that. Maybe they can get their ways corrected. Another one that pops into my head is Amazon. All those that believe Amazon isn't going to be competitive in any way, I just don't agree with that. But it's okay for us to disagree. It's okay. We invest the way that we think the market's going to go. But Amazon looks really good. And I could I could point out 20 stocks that look pretty darn good. So it has been a tough week, Herdo, but it's good to be here. It's good to be here and start rocking and rolling and checking out stocks. Big House, how are you, sir? Big House wants to look at cake. And I believe you want to look at Cheesecake Factory. No problem. We can do that. We're going to take a look at that. It's on the list. The only problem with Cheesecake Factory, every time I talk about restaurants, I'm on the West Coast. I'm ahead of the dinner time. But when I talk about restaurants and I start thinking about, oh yeah, the Cheesecake Factory, my appetite grows. So I'll probably have a very good appetite for dinner tonight. Magical Self, good to see you. What is the intrinsic value of MasterCard and Visa? I can answer that question. So let's take a look at MasterCard. And we're going to take a look at Visa. We're going to do a head-to-head. The head-to-head challenge. Put them in the octagon. See who's going to tap out. Trader Prad, there is blood on the streets. I think it's red. I would just say, a bicyclist fell off his bike at this point. When we're down 15, 20%, we can start using words like blood in the streets. Good to see you, Trader Prad. And man, I got to start listening to you. Tried to warn you about BTC. You warned me about Coinbase, sir. And I listened to what you warned me about. You think Coinbase is not the most stock, and I'm keeping it PG-13 on the stock market. It's a pleasure to have you, sir. And FYI, I tuned into your stream earlier today, and you have one of the coolest intros. I'd love to be that technically capable, but your intros are awesome, by the way. Let's take a look at the next. Sam, good to see you, man. What makes the price of Bitcoin attractive? Really, it's the historical, where historically Bitcoin has traded, right? Let's take a look at the 5-year. So Bitcoin will have these pullbacks like it did here coming through January of 25, and then it rallied higher. In general, we've seen Bitcoin go higher. We have these really jagged drops. This one was a doozy in 2022. That was when the stock market itself really sold off. In 2022, the S&P sold off by 24%, 25%. That's a pretty good one. And the NASDAQ was even worse, like 36 or something. Well, Bitcoin participated in that bear market and sold off harshly. So it may be kind of a canary in the coal mine that Bitcoin's selling off. Now, yours truly, I did buy into Bitcoin here. I did buy in here. I was buying back here. I don't have a lot of regrets. I'm not going to piss and moan about not investing enough. I was adventurous enough to start buying when Bitcoin was under $1,500, but I didn't put a lot of money. Okay. It was so new. I didn't want to risk too much, but I wanted to learn. So literally in 2017, maybe I invested $2,000. And then after that, I invested a little more and then a little more. And it's been probably the number one performing asset in my portfolio because it's gone up so much. So back to your question, what makes Bitcoin pricing attractive is that it has these jagged pullbacks and then I dollar cost average when I think the price is really low. And it's worked out to this point. I'm not a crypto expert. I just think it's an asset class that makes sense to me. We're in a digital world. We are doing more things in a purely digital fashion. Why not have a cryptocurrency that was born on the internet, in the sharing economy, in the connected world, exist? That totally makes sense. International trade. Why not have currencies that are pretty much without country? You can buy a Bitcoin in the US, you can buy it in Germany, you can buy it in China, you own a Bitcoin. It is one denomination for everyone on earth. To me, that makes a lot of sense. And I started investing back then. It's worked out nicely, but it's been a rough ride to see, when it was at 124, boy, it was fun to see that graph. But now it's like, holy smokes, down 30%. And if you wanted to invest in MicroStrategy, so let's see if I think it's under strategy now. So MicroStrategy is even doing worse because these guys use leverage to basically, I think, 3x the volatility of Bitcoin. So on the way up, it looks genius. Like at times, and I can't show that to you for the last year, but yeah, here we go. So you see how it outperformed the Bitcoin itself, but it's really crashed. I mean, it has crashed hard. And I never got into strategy. Actually, I'm in the gym thinking to myself, maybe I should buy more Bitcoin. And maybe I was lacking oxygen, but I thought maybe I could buy strategy because these guys have been just taken out by the woodshed, smacked around, left for dead. This is blood in the streets. This is like there's a body laying out in the middle of the street, and it's called strategy. And I've got to rush him to the hospital. So I was thinking maybe this one might be a good play. So I'm going to give it some thought. I'll probably throw a few bucks either into Bitcoin or into strategy because, man, a 61% drop is excessive, I would say. All right. So there's a full answer on Bitcoin. Thanks for asking. Bo, man, you are back. Giving me $2 again. Do I teach options? I do not. I don't like options for my type of investing. I think there's some people in the community that do use options quite effectively, and one of them being Daryl. So, um, if you, I don't know if you'll ever become a member, but if you can jump on the Discord, there are options. There's investors that use options to, I would say, improve their income, enhance income. Me, I want my portfolio to be more valuable over time. I want to double my portfolio every 5 years minimum. I want it to just keep growing and compound. Options, when I've used them, at times they've kind of have backfired on me, and the pain that I suffered, the losses that I suffered, were far higher than any kind of gain. So I'm like, you know what? I've got my recipe for success, and I'm going to stick to it. All right. So prediction markets, you're all over that, Pratt. I've been paying attention to prediction markets. It's interesting, but we'll see how far it goes. DJ, man, everybody's here tonight. Thanks for tuning in, everybody. You want to look at ESTC? Glad to, sir. I know it's late where you're at, DJ. Thank you so much for tuning in. We'll cover that. Herdo, you are awesome. This is an opportunity, and you do this often, Herdo. I really appreciate it. $5. Thank you, sir. Really appreciate the super chat. Kurt, it was nice speaking with you yesterday. You've been adding more Uber and Oscar. You've been adding more Mara with BTC. Yeah, Marathon, I think you're That's the Marathon Digital, right? I've never kind of figured out the miners, the Bitcoin miners. So I just bought the Bitcoin. I had Ethereum for a while, for quite a while, maybe for 6 years. And then I sold my Ethereum. Ethereum underperformed Bitcoin. So I just got rid of Ethereum. I know that Ethereum, they're trying to stake it and you get some staking credit, which is cool. But again, income and dividends, not the priority for me. I want what Bitcoin has delivered, which is take my 25 grand and turn it into 250 grand. That's what I want over the long haul. So, yeah, so good to see that. Uber, I bought more Uber today. I bought Uber yesterday. I bought Oscar this week. And I didn't buy any Mara because I don't own Mara. And I kind of gave you my comments on BTC. I'll put Uber on the list because I'd like to cover Uber. And we'll put Oscar out there. You know what went up is United Healthcare today. There was a few stocks that had green on the screen. United Healthcare was one of them. Walmart's trying to turn themselves into Amazon. Yeah, good luck with that. Amazon's going to destroy you. Costco went up a little bit. Procter and Gamble, I started buying into Procter, shared it with you guys months ago, and I was moving assets into consumer staples because the market just kept getting more expensive. Now, I don't have a ton of money in here. I just have a little bit of capital with Procter and Gamble, and then I have some shares of Colgate Palmolive. I have a lot of shares of Kroger. That stood up tall today. But this space, when everything else is crashing, this space tends to hold its value. So do utilities. United Healthcare stood up nice and tall. J&J, that's a solid one. McDonald's, if we're all going to be, looking at our portfolios, losing money, we're just going to eat cheeseburgers at McDonald's to survive. No more, filet mignon with lobster at the steakhouse until the market comes back. Auto parts, because people are going to keep their cars longer, so they will buy more auto parts. TJ Maxx, discount retailer, that did well. And after hours, I would say their main rival did really well. I'm going to cover that. Ross Stores. So that did quite well. Then insurance. So I did a video on insurance to members, or for members, I should say, pointing out that, hey, insurance isn't a bad idea going back a month ago. And, here it is. It's not a bad idea because I want to buy stocks. It's a good idea to buy stocks when prices are really good. And when prices are really good is when nobody wants them. And nobody wanted insurance stocks a month ago. Now they're rising. Voila. We want to know where the hockey puck is going, not necessarily where it is, because a couple moves and boom, the puck is somewhere else on the ice. So I saw that the puck was going to move to insurance. Now that we have all this red on the screen, that's the kind of big picture investing that I like to do. I shared it with the community, a big long video, and then I've been cutting out these shorts and posting them out on the website to the public now that it's a month old. So take a look at those when you get a chance. I think insurance is a pretty good idea. Good to see you, Shadow Guy. And I know it's very late where you're at. Thank you so much for tuning in. And good to see you all over Discord, by the way. Be patient. Well, I'm gonna say that I agree with your sentiment. I just wouldn't put the 18 months on there. We're not in a bear market just yet. It's 5%. When we get to a 10% correction, that would be a correction. And then when we get to 25%, we're officially in a nice stock market crash or bear market, extended bear market. I don't know if we're going to get past minus 10. I think that this market does have some good value out there, especially in the sectors that have been left behind, like healthcare energy, consumer staples, industrials, a lot of value here. Consumer discretionary, I really like what I saw at a Target. I know that one's not where our hockey puck is at now. That's the hockey puck right now is with Walmart. The hockey puck is with, I just covered it. It was TJX. Okay, that's where the hockey puck is. But I think the hockey puck in 6 months is going to be all over Target because they're expected to start growing. It's a really discounted stock. I really like where that's going. So I think we're going to have a rotation into those sectors. Now, these can't pull up the whole index because they're smaller. These things are gigantic now. They're massive. So we'll see how it sorts out on the index. All right, man, you guys are bringing it tonight. Thank you, everybody. We got a big audience tonight. It must be because it's Thursday night, prime time. We got a football game starting in an hour. And I really appreciate you guys spending part of your evening with me. Kurt. Yeah, I agree. Catalyst, United Therapeutics, biotech. I've been seeing some really good things there. And these companies resemble technology, growth rates, profits. They just have strong moats due to innovation. I agree. It's really been working. Big house. Every day feels like a paper cut. Very good analogy. Yeah, if we have day after day like this, I'm going to be with you, buddy. I'm not nervous about Uber. I'm gladly buying more shares. Yep. I agree with that comment. We'll take a look at Uber later, and I'll show you the valuation that I have. And then Magical Self, KMB. What's KMB? Is that KMB? I don't know. I'm not going to guess. All right. Got through the comments. I'm not done with the comments. Man, you guys are active tonight. Thank you, everybody. NBIS, I could cover that, but with a $5 super chat, or you can become a member. Then you can request stocks to be reviewed. And then Hugh, you're into Pfizer. I am as well. I just started to go back into Pfizer. I like the dividend, and I like where healthcare is going. Kimberly Clark, that's the name. All right, we'll take a look. That's a nice safe stock. All right, everybody, let's get rolling. Let's start talking some real life stocks, see what's going on. I'm going to go over a request first. We got somebody from Portugal. It is a pleasure to have you. Thanks for tuning in. And man, I am fluent in Spanish, but not Portuguese. Portuguese sounds so beautiful, by the way. When I usually hear Brazilians speak Portuguese because I don't have a lot of people from Portugal in California, but it always sounds, it's kind of like the French compared to Spanish. It sounds so cool. All right, the Cheesecake Factory. Now, this is a restaurant, not my favorite industry to invest in because the profit margins aren't there and they have to put so much capital into creating new restaurants and so forth. So this stock here, it had a nice run. I remember this coming up in the community. I remember on Discord, the celebration of, cake going up. It really did have a nice rise. Heck, man, you're going from $44 up to $65. Rock and roll, huh? But ever since then, man, it's really come down. This is like a nice mountain. It went up and came back down. Now, this one announced their earnings on the 28th. That didn't do anything to stop the bleeding. It's a $2.15 billion market cap company with revenues of 371. You notice that you're paying for a fraction of their overall sales. That's because I'm not the only investor that doesn't like restaurants. They come with a lot of expenses. You have to hire a lot of people. You have to pay them. You have to pay them an honest wage. You have to healthcare, HR, all those things. You got to buy food ingredients. You got just a lot of other costs that you have to spend money on before you get a profit. Whereas if you're a Meta, You run social sites, people go on them, you make lots of money. And those are businesses that are far more desirable. Let's move on. PE ratio is 13 for the current year, moving to 11. Dividend 2.5. Analysts think there's a discount of 34%. These analysts, 15 of them, the price target high is $67, low is 47. So everybody's above its current stock price. And they're basing that on price to earnings. That's earnings per share, excuse me. And it's expected that Cheesecake Factory is going to grow. And they're going to expand profits, bringing their PE ratio to a single digit. So that looks interesting. All right. Now, I'm going to do, I don't know that I have Cheesecake Factory. I may have it as a valuation. Let's take a look. I think I do because it's come up before. I don't, but we can do that rather quickly. Back of the napkin. All right. So this is a growing, slow growth company. And it doesn't make a lot of money. Let's take a look at their margins just to make that point. This is for the full year. And you have Meta, NVIDIA doing 70. NVIDIA is like battling to stay in the mid 70s gross margins. These guys are battling to be at 39, which isn't bad, by the way. 39% gross margins, profit margin of 4.38. So the margins are thin. And this is a good year. 24 is a good year. That's why the stock really took off. But the stock has been dumping probably because the trailing 12 months doesn't look as good. And it actually looks better. So interesting that the market's selling it off. But these are the small numbers that put a low ceiling on cake, that put a low ceiling on Cheesecake Factory. So when I go value this company, I'm going to take their free cash flow. I'm going to multiply it times 15 and then deduct debt. And they have about $2 billion of debt. So free cash flow is $159 million. I'm going to round up to 160, multiply times 15. I get the $2.4 billion is what I would land on if I did a free cash flow forecast, discounted those that forecasted free cash to today's value. And then I deduct debt, which is $2 billion. So I end up with like $500 million of value left over, but this business is priced at $2.15 billion. I'm nowhere near the valuation for Cheesecake Factory. And what I want to see is just fatter margins, right? Let's take a look at, speaking of which, when we look at NVIDIA, this is a $4.5 trillion market cap company, because when you look at the free cash flow, this thing's generating $77.3 billion. Whew. They have $60 billion of cash on the balance sheet with $10 billion of debt, $50 billion ready to buy back shares, do all kinds of stuff. So that's a very big difference between industries. So Cheesecake Factory would be a pass all the way. There's nothing there for me. There's debt on the books. There's a modest free cash flow rate. There's a modest profitability. I'm trying to be nice. And overall, it's a pass for me. So that's my review of Cake. Now, somebody who's been a frequent attendee is Atari Kid. I already told you that I'm a fan of old school video games. I used to have a vintage arcade. You want to look at DGXX. I don't think I've ever covered that stock. Thank you so much for coming, and thanks for sponsoring that super chat. And let's jump all over that one real quick. So DGXX, DigiPowerX, is an energy infrastructure company, develops data centers to drive expansion of energy assets in the U.S. This is probably a very, very important company at this time. The company operates 3 segments: cryptocurrency mining, sales of energy, and co-location services. It also mines for cryptocurrency. The company is involved in power provision, space rental to customers, and sale of electricity. These guys are probably doing really well. I've never covered these guys. Interesting. Okay. All right. I'm curious, what are they using to generate the power? Or did they buy contracts to receive power and then they just resell their rights to those contracts? So, okay, so they're focusing on investing in the infrastructure. Okay. This is one power plant here, Buffalo site, Alabama site, North Carolina. So they have these miners. I mean, right now with AI being super hot, um, I would think that they could use one industry to make both industries pay them more money. Hey, AI companies, you want to buy my power? What price you willing to pay? Hey, Bitcoin miners, you want to buy my power? Again, what price you willing to pay? And then drive up the price for themselves. Um, all right, so I got a little bit of knowledge of what they do. It's interesting. It is a business for the times. Wow, look at that volatility. Overall, 1 year, 63% rise, but boy, you deserve a little hazard pay after the last sell off here. Down 17%. It was as high as $6. It pretty much came down 50% in the course of less than a month, right? Yeah. Over the course of just a couple weeks. October 28th, 29th was kind of like the peak that we saw. And a lot of things started to fall. Dominoes started to fall. This one being one of them. Let's take a look. Let's take a close look. This is a small cap, $208 million, revenue of 31 million. So you're paying about 7 times revenue. That's not overly expensive. Now they're not making money yet. Strong buy with a substantial discount. Now there's only one analyst covering them. How many forecasts are out there? None. All right, so we're gonna have to do this on our own. Okay, so we got a business that's expanding nicely, 41% in the last full year. Let's take a look at the quarterly. What's going on here? Why are you going red on me? Why is this red? This should be green. You're in the middle of a market that is where power is in extreme demand. Why are you like contracting? That makes no sense. And I don't know if Atari Kid, you have um, any kind of insight into why are they contracting? Are they not able to produce power? Are they getting less price for their power? We'll take a look at their financials and try to figure out what happened. Like Q4 of 24, which ended December 31st, 2024, roughly 10 months ago, compared to the previous Q4, they really dropped. So what happened? So that is a mystery that has to be solved. You know, I think the big story, the big picture is a promising one for a business like this. But fundamentals tell us is are they really do they really have um, evidence? Are they operating in a way where they're going to realize the potential of the business? 4 consecutive quarters of contracting growth is the opposite. Okay, so that's really concerning. And it's interesting that it looked like the stock really started to sell off 3 weeks ago. Their earnings came out just a week ago, so it was already selling off. They actually got a bump out of their earnings. So, okay, so there's a concern on revenue. Why the heck are you not growing? That's a problem. So let's take a look at their website, and I want to go to their investor page, see if it's going to be there. And then I want to look at their financials, see if we can make sense of what's going on with this company. Okay. All right. So I just started to open things up. Let's see what's going on here. Let's see if we can get some more fundamental data. This is not, I did not hit any pay dirt there. Get me your financials. I want to see your financials, see what's going on with your business. So current report. So they didn't put their 10K out there yet. Okay. Okay, DigiPower X to announce. Okay, this is the announcement that they're gonna release their financials. Okay, so here's one of their. This is their press release on the earnings, November 13th. They're in Miami. So they're holding Bitcoin. Okay. Man, that's not a good thing right now. If you're holding a lot of Bitcoin, and I just showed you the Bitcoin's down 30%. Looks great when Bitcoin is rallying 30% over the course of a short period of time. So this is a tiny business, right? 200 and some odd $1 million of market cap. So this is a compare between the year that ended, or excuse me, the quarter, the 9 months that ended September 30th, 2025, and a year prior. So digital currency mining was much higher. They've what they've done. The reason the revenue might be changing is they're moving over to co-location services. Okay. So they're saying, hey, let's not do Bitcoin mining as much. Let's move our resources here. And they're not selling power anymore. And it might be that they need it for their other services they provide, or they lost access to it. No, here it is. So they were selling electricity, now they sell energy. What's the difference? So cost of sales is high. So they don't have a lot of margin. You see that there, that their cost of generating that energy is pretty high, as well as providing the services and so forth, to the point where even if you add back depreciation and amortization, that would give us back about that would get us a gross profit of like $3 million. If we divide their total revenue, which is going to be 25 million, it has gross profit of like 12 to 14%. That's not very good. It's not NVIDIA at 75. All right. So, all right. Let's see if they give us any other financial statements. Nope. Just the income statement. So this one here, it looks like they're trying to move from being a crypto company to being more of a data center company providing services to that data center. Not a bad idea. That's what CoreWeave did successfully. I'm not a big CoreWeave fan, but they successfully went from being a cryptocurrency company over to being a data center services company. This one here, it's got a lot of risk on it. The numbers are very rough. They're not making money. They're losing a little bit of money. A lot of it is in depreciation, which is not a cash item. Got it. But they're sitting on a lot of Bitcoin. They're not showing me the balance sheet. Let's see if they have a balance sheet elsewhere. So yeah, they have 85 million in Bitcoin and Ethereum. And they produced this report on November 3rd. I just showed you the graph. So this 85 million is now, take 25% off of that. So it's now like 65 million is the balance. So they lost some money there. Yeah, this one here, it's got a lot of risk, and it's hard to really pinpoint the value of this business. They're completely restructuring the company, changing the business model. Is it going to be successful? It could be, but it's really risky at this time. And meanwhile, the market, at least before October 28th, 29th, the market was just crazy about AI companies. So there's probably some euphoria priced into the stock. I could see this stock selling off even more and really settling down like back to maybe $1.50, $2 until they get bigger, more reliable. There's more confidence in their business. Then they move higher from that point. This one here is telling me this stock is going to have a hard time going forward. I think we're going to go lower from here. I think the AI trade, if numbers as good as what Nvidia provided, as well as other companies that provided really good numbers, cannot cause their stocks to go higher. They actually contract. It shows that the market doesn't want to pay up as much as it was paying up for AI. And tiny caps like this are going to be treated far worse than our friends at Nvidia or Amazon. Those are name brands that people really, really trust. So this one I would stay away from. I think this one's going to settle down around $2 a share. And maybe in some point in the future, it might be a good risk reward to consider. That's as far as I can go, Atari Kid. Let me see what your comments are on here. They don't have a lot of debt. They're carrying some Bitcoin, so that should be taken into account. I agree. But the bad thing about that is that the Bitcoin has been getting hammered. So, man, I wish I had something to lean on. And then the contraction in revenue, don't like it. Don't like it one bit. Thanks for asking, man. Thanks for coming back. Good to see you. Really appreciate the super chat. Looks like, man, a bunch of people are in. Thank you so much for joining. I'm going to carry on. I got a list of stocks that I've got to get myself into analyzing these stocks so we can cover them all. All right. So the next one I'm going to cover is going to be, this is the face-off. This is the Visa versus MasterCard face-off. Which one is a better investment? Now, both they run these financial platforms, and they're, in a way, they charge a toll. They've got their network. It's been built. And when people use a Visa card, Visa gets a piece of the action. They don't do much anymore because they already built the network. They get a piece of the action. Now, this business, when people talk about moats and stuff, they talk about this stock, but it does carry a pretty high PE, 31.73, forward P 25.28. And the stock hasn't been setting any records for the last 12 months, showing that, hey, investors have already paid up for this stock. And it really hasn't set any records for the 5-year. So it's been a decent stock, 56% is decent, small dividend. So that's where Visa's at. It's a consistent company, growing consistently. We look at their growth, 11% growth. And this year is the full year, ended September 25th. So that's perfect. This is good, consistent growth. Can't argue with it. And remember, we were talking about margins. Let me just show this to you to show you what is possible. Visa has 97.77% margins. Operating margin, 67%. Profit margin, 49.6. Free cash flow yield, 54. Beautiful. No surprise that a business that has that kind of fundamentals carries an overall market cap valuation of 619 billion. So this is an example of a valuable business, but it may not be a good time to buy. Now, one of the lessons that I would want you to observe is go find a business that's smaller, that has these characteristics, that hasn't been discovered yet. And you discovered early and you buy in and then you make a lot of money. Okay. So that's one of the lessons that I would want you to observe. Visa is a really good example because historically, this thing has been a wealth generator. People have taken the elevator up. They've put, 10 grand in and woke up with, 200 grand in their balance. And that's great. That's exactly what we want. But maybe it's just that's rear view mirror. That's in the past. What about the future? All right, we're going to answer that question. Before we answer the question for Visa, let's take a look at MasterCard. MasterCard's the little brother. It's not quite as big, smaller market cap, but it too has a network. It's been slumping. Boy, it slumped today. Year to date, it's barely hanging on to a gain. The 1 year, like Visa, not too hot. Look at that. They kind of follow each other. Very similar margins, similar everything. So let's take a look at them and let me see if I've got a valuation for these guys. And I know that we had a new member. You get access to the valuation repository, and then you can 24/7 look up these valuations. Now, I don't have Visa, but this would be a nice little project for us to crank out. So let's do it. So Visa, I'm going to put right next to PayPal because they do have similar businesses. PayPal is different. It's not the same type of business, but I think it's a good starting point. So I'm going to copy this model and we're going to crank through two valuations, one for Visa, one for MasterCard. I'm going to work through this quickly. So this model I created, but it's created on the principles of finance, the principles that, investors use. And we get a lot of data in the world of investing. There is such a thing as too much data being available, too much noise. So that's why I wanted to create my own that was simple. It just looks at the most important things. And that's what I'm going to take you through here. We're going to crank through this. Now, Visa is super stable. I'm going to go with 7.5. I may change that to 7 because it's like these guys aren't going anywhere. Now, I'm going to go with a 10 because I saw that their growth was 11%, then 4% long-term growth. Let's go find their free cash flow and then pop that in there. So now stock analysis will give us our free cash flow so we get to cheat. Free cash flow is cash from operations minus capital expense, gives us our free cash flow number, which is $21.5 billion. Whew, that's a lot of cash. That is a lot of cash. All right, 21.5. I'm going to change that a bit. And okay, so we got our free cash flow number. Now I'm going to grow that because we're always looking forward. Okay. We're not static. And looking forward, I'm going to multiply that 1 times the growth rate. The growth rate I have on Visa is 10%. So the first initial 12 months, looking forward, I expect they're going to do 2.1, and that isn't correct. I need one more 0, 2.1. Okay, and this should be a plus. User error. Okay, now it looks right. I expect 23.65 billion. Okay, now using a discount rate, taking you through this, Next 12 months, 23.6 billion. And then it's going to grow by 10%, then grow by 10%. It's going to compound. And then terminal value is all cash flows after year 4. And when we discount all those cash flows using a discount rate of 7.5, we get a net present value of 742 billion. Now let's take a look at their cash and debt. I'm going to look at them real quick so we can pick up the pace a little bit. And their cash is 19 billion. And their debt is 26 billion, 80 million. All right, so shares outstanding are incorrect. We can correct that. I just need to copy a lookup. Our friends at Google give us these lookups that are good to have in these models. That way we don't have to enter our share count. We just use the lookup. Looks up the share count, pops it in there. So if I compare the free cash flow value of Visa compared to its current stock price, 26% discount. Now let me take a peek at their earnings per share, and I used the forecasted for the next year. We're always looking forward. We're investors. I don't care what you did 2 years ago. It's good to know, but I care about what you're going to do the next 2 years. I want to know what you're going to do while I hold your stock. Are you going to keep growing, improving? And in the case of Visa, it's expected they're going to keep growing, which is very good. Now, their earnings per share next year is going to be $13.05. They're growing that nicely in the following years by 12.8%. So I'm going to hedge my bet and go 11. And you see that earnings per share doesn't, and that's because of PE. So Visa is a prized stock. I'm going to go 25. I don't like to go beyond 25. Maybe we go 28 because it is a really good company. So Visa is discounted by 24%. It's a solid investment because it's Visa. It's super solid. Everybody uses their Visa card. This business is pretty much set. They're going to keep growing the way they're growing. So let's take a peek at MasterCard. What is MasterCard worth? All right, so let's do that. Now that I got Visa as an example, let's put MasterCard here. And I'm going to look on a screen you guys can't see just so I can crank through this real quick. And MasterCard has a different symbol. Oh, look at that. Some type ahead features that get in the way. All right. So same discount rate, same industry. Let's take a look. So MasterCard. Now their growth rate, when I look at their forecast, is a little better than Visa, just like 1% higher. So I'm going to keep it at 10. All right, so let's take a look at their free cash flow number. See what kind of cash flow we're dealing with here. $17 billion. Again, these guys have big caps because they have big cash production. So remember that. The lesson is, okay, you generate a lot of cash, you get valued really high. So where could I go find a smaller business that's going to have an awesome network like this? They make great margins. They make great cash. I just see it before others, and then I make lots of money. All right, so this one here is going to grow nicely. Its net present value cash flow is 587. Let me take a look at cash is 10,650 million, and debt is 18.98 billion. So it's a discount of 19%. So this lackluster performance for the last year has enabled this stock to be priced more adequately or offering investors a modest discount. When we look at the earnings per share for MasterCard, it's expected 19.68. P ratio, we're going to keep it the same. These guys are going to grow better. So look at that. So the face-off, the cage match in the octagon, it's a decision the decision goes to Visa. And the numbers tell me Visa, and Visa has an advantage on brand. Visa is bigger, it's more recognized, it's a better company. I don't know about using the word better. Its brand has more value. That's where I would leave it. I'm sure MasterCard's a good business. But if I had to pick between the two, Visa wins the battle between these two companies. It is priced better. It's not a bad idea right now. It's a modest discount, but you're buying a very solid business. You'd probably do 10, 15% rate of performance on these stocks. Okay. I mean, you're not going to buy the next Palantir. You're not buying the next NVIDIA, but you're buying something that's super solid for those investors that are interested in it. So there you go. There is the face-off, Visa versus MasterCard. Visa wins that battle. Now let's move on. An investor through Discord wanted me to look at Bath and Body Works. I've never looked at this stock. They went down 24.81. They announced their earnings. Obviously, not good news. Over the 1 year, down 48%, 5 year. Now, retail is tough, and this is specialty retail. They do a lot of beauty and kind of a lot of women's products for, personal care. And these guys here, market cap 3.26. Boy, they've gotten a haircut in the last year. 48%. Their stock's down 48%. Year to date, 59%. This one just looks it doesn't look good from any angle. It's a business that's really been left for dead, so to speak. And market cap 3.26 billion, revenue 7.35. They do have a net income, and look at their PE ratio. Jeez, super low. Market doesn't care. Analysts think there's a 141% discount. I think we got to check this website because there's no such thing as a 141% discount. The biggest discount you can get is, pretty much 100%, right? Because then that would be free. Anything beyond that would be literally the company paying me money to accept their stock, which I don't think they're willing to do. We've got 16 analysts covering the stock. They all believe it's much, much higher. And they're growing. Interesting. So they're growing their business. They're expanding their profitability. They're in a year. This is their fiscal year, ends February 1st, 2026, where their profits contracting a little bit while they grow. This is a good opportunity, but fundamentally, this is a discounted company. When is it going to rise? I don't know. It doesn't have to rise much to give you a good return. We're down to $15.82. If this thing can get back to 25, you're golden. That's not out of the question, right? This stock is traded at $60 a share. But this one is a bottom feeding situation, but the company is fundamentally sound. Let's take a look at their balance sheet. See if there's any skeletons in the balance sheet closet. Maybe there is. $5 billion of debt. Ooh, okay. Net debt 4.74. Debt to EBITDA 2.63. Nope. There is debt. Not a big deal. They can pay it off in less than 3 years. That's an acceptable balance sheet. I want it less than 3. And that's an acceptable balance sheet. So this one here, highly discounted stock. I agree with the analyst. When is the stock market going to buy this stock? I don't know. That's a hard one. I think it may bump along the bottom. Right now, it's not a bad idea to throw a few bucks at it because I think the whole data center, and they pay a dividend of 5%. And that dividend has gotten that big because the stock price has gone down so much. So if you're a dividend investor, not a bad idea. These guys are going to stay in business. They're going to grow. Not the right stock for me. I don't want just pure income stocks. And but if I felt like they were going to rally, I'd throw a few bucks at it. But this one here, I think, is an opportunity, but it might take a while. It might take 3 months, 6 months. But once it starts to move, this one's probably going to reward investors very quickly, 40, 50%. The other thing you got to think about is what's your exit strategy? You got to have it on a stock like this. So you can't say, oh, I'm going to sit on these guys for 5 years. It goes from 15 to 30, then it goes back to 15, and you'll be like, oh, no, I should have taken the gain. So have that defined. Hey, once it gets to a 40% return, I'm out. I'm not taking any chances beyond that because this stock has proven to sell off very harshly. So that's BPWI. Fundamentals look fantastic. All right, get out of the way, Walmart. We're going to look at ESTC, Elastic. Elastic, a search artificial intelligence company, provides software platforms to run in hybrid public-private clouds and multi-cloud environments in the US and internationally. So it offers Elastic's AI platform. Okay. Let's take a look at their website. We looked at this stock, but it's been a while. So their solutions. So e-commerce search. So it's just kind of like a software play. Okay. All right. So these guys are headquartered in the Netherlands. Okay. $8.7 billion market cap, revenue of $1.6 billion. Not too expensive there. Forward P of 33. Analysts think it's discounted. How have they been growing? 17% in the last full year that ended April 30th. Quarterly looks good. 16%, 19.5. These numbers look healthy. Very good. What kind of margins are these guys making? So they're making some good free cash flow. Gross margin is 75.6%. Remember the example of Visa. High margins, high cash flow. This is a small company. Are we going to find something that's going to, be small, not really well known, not being found by too many investors? Maybe. Let's keep going. So this is high margins. Now they're little, so they're not making a ton of revenue, so they're not getting that margin down because they're probably putting a lot of money into research and development, buying equipment for their data center and all that good stuff. So they carry a net loss. You see that their cash flow is positive because you don't have to take depreciation against your cash flow. Looking at what 25 analysts cover it, that's a pretty good coverage. And every analyst believes they should be priced higher than their current stock. Very good growth in their forecast. Very good growth in their profits. Their PE coming down to 12.5 in fiscal year 2029. So that looks really attractive. Very attractive. This is a small cap software. In what category does software application? Yeah. And this has just been a really tough area. There's a lot of businesses here that are being mistreated, like just thrown out with last week's garbage. Salesforce, Adobe, ServiceNow, even Intuit was being thrown out with last week's garbage. So those are bigger recognized businesses. So when we deal with an Elastic that's a tiny business, yeah, the market's going to not be ready to buy this up. They're going to be cautious. Man, when is software going to ever do well? The sell-off is intense. It sold off 7% during the day. We had a horrible day on Wall Street, got it. But then after hours, holy smokes, down 13%. Whew. That's a rough day. Looking at the quarterly, yeah, the numbers are in. So the numbers were a little light on growth. But I mean, come on, let's not throw the baby out with the bathwater. It's light growth. I get it. But let's not have a freaking heart attack over it. Cash flow is light as well. That's 2 yellow flags. Margins are okay. So I can understand why investors sold it off. Like, hey, you're not going to grow as fast as I would like you to grow. You didn't make as much cash as you did in the quarter. I got it. But I still think it's discounted. I still think, I own a lot of software stocks, and I'm watching a bunch of software stocks because I think once software starts to work, it's going to really work. We could see a rotation into software. For some reason, the stock market thinks AI is going to put all these software companies out of business. And I don't believe that, because software has certain capabilities that deliver particular needs of businesses or consumers. And that's not going to go away. And AI is not going to replace that very quickly, maybe in 10 years. But for now, these businesses are going to continue to grow, as Elastic has shown. Now, I don't know that I have a valuation of Elastic. Let's take a look. I do. And last time I evaluated it, 29% discount. Now, I use a higher discount rate because it's not a known commodity. Okay. As interest rates move down, the value of these businesses go up. So Elastic's a good watch stock for me, but I'm not ready to jump in head first on it. It's interesting to see how the market's just abusing these companies that are good businesses. I think at the right time, this is going to be a big opportunity. Once they start to work, I'm gonna keep some dry powder to buy into these companies beyond what I'm already invested in. I'm already a stockholder of like 6 different software companies. So it's not like I'm not paying attention to this space. So that is Elastic. Good fundamentals. It's just not receiving a lot of investors right now. All right, let me look at the chat. We got 4 stocks on the list. Just want to make sure I'm saying hello to everybody. So I don't text. If you want me to look at stocks, the rules are at the very beginning of the chat, and same thing with PayPal. Kimberly Clark, we're gonna hit that one. It's number 4. Number 4 on the runway. NASDAQ is at 9% sell off from the top. Yep. NASDAQ sells off even harder than the S&P. All right. So we're up to 56 people on the stream. Awesome. Thanks everybody for joining. We're going to keep rolling here. Let's get to Uber. Somebody asked about Uber. Somebody was buying into Uber. I'm buying into Uber. It's selling off by 7%. The market is at times really sold off Uber, like obviously here because everything was being sold off. But you see this chart, that looks pretty darn good. It has this recent sell-off, but everybody's been taking a haircut since late October. Hey, everybody, we're going down. We're going down in price. And Uber has certainly seen that type of drop. Now, that's an opportunity for me because I do have a lot of optimism on Uber's business. Now, that comes from the fact that they've gotten themselves to be a nice big company, $49.6 billion of revenue, $173 billion in market cap. P ratio is nice and low, moving to 24. Analysts think there's a discount. Now, when we look at Uber and we look forward right through the windshield, not through the rear view mirror, we're seeing growth. We're seeing the company grow 15% on a big number, getting up to $60 billion in revenue next year, 14 and then 11. getting up there to $76 billion of revenue. Their profits are expanding faster. They have opportunities ahead. Somebody might label them as a risk, which is robotaxi. But what if Uber uses their very well built out customer base and they use that customer base and offer robotaxi? I think that would be a recipe for success. So they could actually grab that opportunity and run with it. So when these guys are growing at these rates, according to the numbers, this is just math. Their PE is going to drop into the teens. I don't think it's going to drop to the teens. I think it's going to stay around 25, which means the stock price is going to go up. That's my expectation. That's why I'm holding Uber stock. I'm buying more of it. I own a big position of Uber. I am very optimistic that they're going to make it happen, that they are going to do really well. My valuation of Uber, and I'm going to go back to it after I go to my valuation, just so that we can look at why is this thing so valuable. I could actually cover it here. What's really valuable because they crank out cash. Think about a business like we looked at Cheesecake Factory earlier. Cheesecake Factory, they decide, hey, we're going to open a new location. We're going to open it in, let's say Los Angeles. Well, they have to pay for everything. They have to pay for the build out of the actual property, the kitchen, all the appliances, everything. They have to pay for everything. They have to pay for the tables where people sit, all the equipment. Cheesecake Factory has to pay for it. Uber, on the other hand, says, hey, we want to put another 1,000 drivers in the city of Los Angeles. Those drivers buy their own cars. Uber doesn't have to pay the drivers a hourly wage. They're gig workers. So that's a huge advantage. It leaves a lot of cash left for this business. And it drives a lot of cash. And what we learned from looking at Visa, or if you look at NVIDIA, if you look at Meta, high cash flow producing businesses get high valuations, are destined to be the most valuable stocks on the market. Uber is one of them. They drive a lot of cash. They drive a high valuation for themselves, to the point where their cash flows are worth 69% more than their current stock price. And earnings per share look good too, 34% discount, but overall 62% discount on Uber because of that cash. And think about their business model. It makes sense, right? Yeah, you can make a lot of cash if you don't have to buy any of the cars that are being used to drive people around. Beautiful. That's a very sound business. So Uber is a solid business. I'd also put DoorDash in the same model because DoorDash does the same thing. If they want to hire more delivery people, they don't buy cars. They just get more people on their network and away they go. So that's where Uber lands. Uber is a fantastic company. I like their stock. I've made money on it already, but I'm not done making money. I think it could go up to $1 trillion over the long haul. Right now, Uber is at 173 billion. We're having this pullback. It's an opportunity. I'm going to buy shares of Uber at $83 all day long. I'll buy more shares because eventually I think it'll be much higher, maybe going up to 120, 150, $200 over the next 5 years or so. We'll see how it goes with Uber. Now, if you want halfway between a nice, calm, stable stock and a real aggressive stock, I've got Oscar for you. And it looks like my cousin, Raphael, is on the stream. Good to see you. Good to see you on the chat. All right. So Oscar Health. Now this stock here, talk about volatility, man. You don't need roller coasters in your life if you own this stock. Now I own this stock and I'm in the stock because of the fundamentals. This company provides health insurance to individuals and it provides it to small businesses, which is a big population of people that need healthcare insurance. And market cap, 3.44 billion, revenue, 11.29 billion. So you're paying a fraction of overall revenue, which is normal because this is a health insurance company. Now, a lot of analysts are freaked out because there's been some government changes making it harder on health insurance companies. But these insurance companies, keep in mind, if they're not making money, they get to charge more money they get to adjust what they're going to pay for. It's like, hey, we have to make money to stick around, or if we go bankrupt, nobody gets insurance from us. So they do two things: they cut cost, they pull back on maybe some of the benefits that they're going to cover, and they raise prices. So they'll be able to do that over time. I know people don't like to hear that, but that's just reality. It's a business. It's not a nonprofit. It's not a government agency that's just going to take losses like the post office. Now, this one here is going to grow this year, 2026. There's expected to contract, and I'm not quite in agreement with that. It's actually a company that I think is going to continue to expand. And where's that coming from? Well, it's coming from their financials. When we look at their performance, it actually looks pretty darn good. 56% growth. These are really good chunky numbers. And people want health insurance. They don't want to go on with, without having coverage, because, it's one thing to be able to go to the doctor if you have a cold, but really health insurance is for what if you do get one of those really bad illnesses. You want to have health insurance so that you basically can have that as a safety net, and you don't have to go bankrupt in trying to keep yourself alive or keeping somebody that you care about alive. That's why we want health insurance. We want that safety net. So I think that Oscar is going to surprise that they're going to grow. They're led by a CEO that came out of a big insurance company, Aetna, that was sold to, I believe, CVS. And then he came back as CEO of this startup thinking that, hey, they can do a really good job selling to individuals and small businesses. And I think they're going to pull it off. Got a modest position with Oscar. When it really pulls back, I buy shares. Other than that, I'm just holding. I need more time with the stock because I think it's going to perform well. Now, these guys don't have anything to do with data centers or AI. So that whole sell-off may create some new investors into healthcare, especially healthcare that's growing like Oscar. So that is Oscar Health. And staying on the theme of healthcare, let's talk a little Catalyst Pharma, which has been a really good stock for my portfolio. Catalyst Pharma was up a little bit today because healthcare did catch a bid. You have technology stocks selling off, but some of the money ended up in healthcare. And when we look at Catalyst, we have a $2.8 billion market cap company with $578 million of revenue. It has a very reasonable PE, 13 and 15. Strong buy, according to analysts. When we look at this company, it's been a good grower. Growth is slowing down because they're getting bigger, but the growth has been good. Looking at a forecast for Catalyst, all 5 analysts believe it should be priced higher. And they're basing that on the fact that they're going to continue to grow. And their drugs have been doing well. They have a new drug that the FDA deemed to be worthy of being approved for the next phase of the trials. And that drug is going to come into the picture in 2028. The stock rallied on that news. So Catalyst provides a nice growth, very inexpensive valuation, good acquisition target. It has really good fundamentals. And it's all about buying when the buying is good. I bought this stock when it was much lower, and it has had a wild ride. But you can see over the 5-year, buying at the right time, you can take the elevator up and see your portfolio win. All right, so let me tune into the football game here. I got a TV behind me here. Let's see if I can get the football game lined up and I can watch it in the background. So it's going to be the Bills against the Texans. The Bills are the favorite, and the Texans, they could surprise the Bills because they have some pretty good talent, but we'll see if they show up to play tonight. The Bills have been a little bit of it's been surprising they've lost the number of games they lost. I thought they were going to dominate this year. They came out and beat the Ravens, and then after that, they've kind of had problems. All right, so we covered Catalyst. We're good with Catalyst. Kimberly Clark, thanks for being patient. I think I forgot who asked about Kimberly Clark, but I appreciate your patience on it. All right, so this stock did work. It worked because it's a safety stock. When all these growth stocks are selling off, Kimberly-Clark is still going to sell toilet paper. It's still going to sell all the consumables that we buy from this company. It's still going to be a stock that does well. And it has a $34 billion market cap, $19.7 billion in revenue. So it's not even 2 times revenue. P ratio 17.5, forward P at 13.4. Dividend looks pretty nice, little light of 5%. Now, this is not a high appreciating stock. Let's see if stock analysis needs to buy a couple more GPUs from NVIDIA. See if I can hit refresh here. Here we go. Come on. Guess I'm going to have to go to Google, see if Google has bought enough GPUs to give me a stock chart. So Kimberly-Clark has not had a good year. It's down 24% if you look at the price of the stock. Now, that could be an opportunity, especially if we have an expensive market for growth stocks around the data center and investors are moving to safer ground. It may be a good investment that investors are looking for. This dividend is attractive to a lot of investors. This company is very much a slow growth company. It's a very mature industry. Consumers are buying their product. They tend to be price sensitive. You can't raise the price too much in the grocery store. They'll buy the other brand. And so this company isn't going to grow a whole lot. Kimberly-Clark has, I imagine, some debt. They do. They have a little less than $7 billion of debt. And they have debt to EBITDA of 1.74. So the debt isn't a big problem. It's just debt. Looking at their cash flow, they do about $1.67 billion of free cash. Since it's a stable business, good reputation, maybe we go 15 to 20 times free cash flow. We're going to get ourselves to about 32 to, it would be 25 to 32. It would be the range of their valuation minus debt. And they have about $7 billion of debt. Their market cap is currently 34. So it's going to be hard to get this valuation. I think it's priced too high. And the valuation has really been the reason why this thing's been selling off. It's just, it doesn't carry enough value. It doesn't generate enough cash, doesn't generate enough profits. It's most definitely a needed business, but it's not that attractive. That's why investors are not taking this stock higher. I would not personally buy Kimberly-Clark because I'm seeing that this stock could maybe go sideways and pay a dividend. I'm not looking for that. I'm looking for a stock that's going to double over the next 5 years. I'm not looking for stable sideways, pay a dividend. That's not my cup of tea. My cup of tea is catalyst. Take me higher. Take me 585% higher over 5 years. Don't take me here. This is a nightmare. I stuck around with you for 5 years and you took away 27% of my capital. Forget about it. I know it's sold off, but it's sold off for a reason. You might catch a short-term gain, a little bounce, but that's about it. I think there's other opportunities with safe stocks. You know, the stocks that I'm going into, I think Procter & Gamble is fairly priced and just as solid could be. And this company pays a decent dividend. It hasn't done anything in a year. Over the 5 year, it hasn't done much, but this has a far better brand. And look at this market cap, has a very high credit rating. And the other one is Colgate-Palmolive. This one has a better valuation. It's, been going up higher recently. And year to date, it's also been pulling back because all the money going to the data center. But those two are two stocks that I'm buying into that are more safe stocks. And then last is Kroger. Kroger's been an absolute winner for me. It's a grocery store. And you look at their rate of return, they doubled. They doubled 102% rate of appreciation. And I got paid a dividend along the way. That's exactly what I'm looking for. It's a safe stock that's really returned a high appreciation. So I'd rather go there. I want my cake and I want to eat it too. I want appreciation. And if I get a little income, that's fine too. All right. Let's go back to the chat here. I think I'm all caught up. Look at that. We covered 10 stocks, everybody. Thanks again for all you super chatters. Thanks so much. That's really cool of you guys. And again, thanks to the new member, Smith & Wesson. Please get me your email address. You can email me at victorhinvesting@gmail.com. I'll provide you all the perks that are coming your way. And if you joined a little after I started, our friends at Stock Analysis are running this giveaway, and you can participate by going to this link in the chat. It's right underneath the top link. And you can guess as to what the NVIDIA stock price is going to be at the stroke of midnight on Sunday before we open on Monday. And whoever gets closest is going to get 3 months free of Stock Analysis. So it'll be fun. It's free. And I've already had a number of people going on X and putting their price target up there. And go out there and put your price target. Hopefully somebody on this stream will win. All right. So, all right, Bo, man. Have you had major growth on dividend stock beef? So Kroger is an example of a dividend stock. Let me think of another one. There's also, this one was super risky. I was in and out. And God, what was that stock? I already forgot about it. But it was a material stock. I made 50% like in 2-3 months, and it paid a very high dividend. So, and then there's also Zim. So if you get into industries, right now, investing is really hard. So you don't have to make it any much harder on yourself. You shouldn't try to like go into dividend stocks with the expectation that they're going to go up in appreciation as fast as, let's say, a pure growth stock or a biotech stock that's really growing but not paying dividends. But these are situations that maybe you're asking the question on. So if you bought Zim at the right times, man, you doubled, tripled your investment, and you were paid a big dividend, but you needed to know when to get out. Remember, you need to have your exit strategy before, or I should say, when you buy this stock, I'm getting out when I go up to this amount. A stock that I made money on, did really well with, was Panel. These guys pay a nice dividend. I bought them here. I took the elevator ride up, got paid dividends, and I sold them before they crested and went over the waterfall there. You got to know your exit plan. So this one did reward me nicely. I went up, 4x on this stock. That did really well. And more recently, let me look up the stock real quick. What was that stock? AMR. So AMR, I saw it on a famous investor portfolio. It just been beaten down, just down to nothing, right? And I got to a point where I was like, this thing pays a really nice dividend. I'll go back to the dividend in a little bit. But I thought, hey, it's worth, my time if I can invest in it. I threw a nice chunk of capital into it. And this thing just took off on me, and I had an exit strategy. Once it hits 40%, I'm out. And I made that 40% in like 2, 3 months. So made a nice clean, appreciation and got out. I had my exit plan and I'm done. So there's an example of looking at a dividend stock and making money very quickly. Zim, Panel, Alpha Metallurgical, but these are not like long-term success stories, right? It's not like let's go with Google. Like Google is nice, consistent riser, right? Okay, you bought into Google, you put 10 grand in, and you wake up 5 years later and you have 30 grand. Great. I tripled my money. Beautiful. That's what we want. That's Google. They don't pay a dividend. They pay a tiny dividend. It's not really all that meaningful. If you go after those dividend payers, they can have spurts and then they fall. So that's how I invest in them. And I would caution you just to look at it. And the other thing too with dividend stocks is, you may see that the dividend, once the dividend date comes up, the stock could fall. So, how do you want to play it? For me, in my investing, I'm after appreciation. I don't overly focus on dividends. I think dividends could be a kind of it could lure me into the wrong investments. I would rather have stocks that I believe in, like Google, Robinhood. I talked about Uber. Stocks that are going to take my capital and more than double it every 5 years. If I can achieve that, I'm very, very satisfied. That's exactly what I want to do. And I got to keep my investing approach as simple and repeatable as possible, because whatever works, I want to do it again. An example of that is, I found Robinhood early. I invested in Robinhood. Robinhood's done great. Looking at where we're at, I'm very happy with Robinhood. So I didn't stop there. I went off and found Futu, which is the same type of business as Robinhood over in China. Now this thing's working for me. So once I find a business type and I find, hey, I hit pay dirt with a stock, let me go find another one. These guys don't pay dividends. I don't care. You return 72% rate of return in 1 year. I'm good. You don't have to pay me any dividends. I'm good. Just keep going up in stock price and I'll be very happy. So Bo, I would really love to have you as a member, because you can join the member calls. You can go Discord. You've been on the streams a lot and I really appreciate it. You're always welcome. It would be great if you could become a member just so that you could have more access. Thank you, sir. All right. So there were a couple of stocks that announced today. Let's go back to the earnings announcement. This is incorrect. Alibaba is going to announce on the 25th. And Walmart announced today. We'll take a look at that before the market opened. Intuit, the great Intuit. NetEase. Let's take a look at that. Ross, discount retailer. Viva Systems, I think they do software for industries or for industry. Copart, I'm not sure what they do. All right, and we looked at Elastic. Elastic was getting beat up. All right, so that's where we're going to go. Let's take a look at those companies, starting with Walmart. So Walmart has been flourishing. They're up 111%. And this is a safety stock with a high PE. Why the heck does Walmart have a high PE? They don't really grow a whole lot. They are a big cap, $854 billion in market cap. Holy smokes, that's a lot of money for Walmart. They do have a lot of revenue, $693 billion. P ratio, again, is pretty high. Dividend is a little low. And they've been trying to cut into Amazon's action by trying to do more deliveries. And I think it's working to some extent. They're also going across economic lines. Like they have traditionally been a discount retailer. You get good value at a Walmart, but now they're seeing that even more affluent, richer people are coming to Walmart to buy stuff. Hey, that's a good idea. Get a good deal wherever you're going. I shop at Costco. I love the value I get there. And these guys have been growing steadily. Looks good. Quarterly, 5%. So the company gets really is satisfied with Walmart when they can come in and grow single digit at their level of, their size. 4.76% really adds up fast, right? You're doing almost $200 billion in the quarter. Amazon's doing more, and Amazon's more profitable, by the way. And they also have a higher market cap. 27 analysts cover them. Now, some analysts are saying, hey, the stock's getting a little pricey. Some analysts are like, hey, it can go higher. They think on average, it's discounted by 7%. They're expected to keep growing. All right, that's totally doable. And their profits are going to expand. PE is going to stay elevated. I cannot see myself ever paying a high 20 PE for Walmart. It's a retailer. They don't make a lot of money. It's not like some of these really attractive companies that we've been looking at. Gross margin, 25%. That's terrible. Profit margin, less than 3%. That's terrible. It's not good. But some investors are like, hey, it's Walmart. They'll make it up in volume. Maybe. But I'd rather buy Amazon. I have a valuation for Walmart. I actually did a video for members covering all the retailers, the 10 biggest ones. So they've seen this before. I'll show it to you. I actually think Walmart is priced 49% too high. Let's examine that. Remember, Visa was doing more than $20 billion of free cash, and Visa has a lower market cap than Walmart. So Visa generates more cash that goes on the balance sheet, can be used to buy back shares, could be used to acquire other businesses. You can do all kinds of great stuff with that. They generate more cash and they have a lower market cap than these guys. That's the beginning of why I think these guys are very overpriced. And they're not going to be able to, all of a sudden generate more cash because they have low margins. So on top of that, they have a lot of debt. So I think their true intrinsic value adjusted for debt is $326 billion. But the market really likes Walmart, pays $853 billion for the company. I think this is setting up to really give investors that are in Walmart a real rough next couple of years and underperform for the next 5 years because these numbers are not even close. PE, I'm not going to pay 35, 40 for Walmart. Showed you the margins. They're terrible. And the growth rate, I'm going to grow their profits by 10%. And even when I do that, 24% premium you have to pay on Walmart. So this is absolutely a sell. Just way too expensive. They announced today they went up higher. Part of it is that the investors wanted to get out of these high-flying AI stocks that are related to the data center, and they wanted safety, and Walmart gives you safety. But I'd rather be in cash versus Walmart. So Walmart had their day. We'll see where it goes. And that is Walmart. Intuit, one of my favorite companies. I've been an Intuit customer for a long time. I've done my taxes since I was 18 years old. And early days, right, I didn't make any money, so it was simple. You'd get the forms. You can get them mailed to you, or I forgot where I would get them. I think I'd go down to the IRS office and then fill it out. Actually, they mailed them to us. They would mail you a tax package. You'd fill it out, send it in. You're good to go. But along the way, in my mid-20s, I started buying TurboTax and have been a TurboTax customer since. So this is a real sticky business. And then their QuickBooks business helps small businesses do their accounting and administer the businesses. Really sticky. So overall, this is a $177 billion market cap company. Revenue is 19.46. PE is a little high this year, but coming down to 27. Pay a small dividend. Analysts think there's a discount. Now, this stock over the 5-year has done okay, 76%. They've had a pullback recently. As I mentioned, software stocks are not receiving a lot of love in 2025. They're actually being put on the watch list like, hey, maybe AI is going to hurt them. Maybe it won't. But let's see if Intuit's growing or contracting. So looking at the quarterly, our friends at Intuit are growing quite nicely. 18.34 on a big number. And that growth surprised the market. Wait, you weren't supposed to grow that well, but they did. And when we look at their gross margins, 80%. Get out of the way, Walmart, 25%. I don't want to waste my time making 25%. How about 80? That looks a lot better. Operating margin, 26.7%. Profit margins, 21%. Don't those numbers look fantastic? Free cash flow yield, 33%. That's why these guys became $172 billion market cap companies, because they just drive a lot of profit, value, cash. Okay. Now, the free cash flow per year, in this, is this my trailing 12 months? I believe it is. Close to $6.4 billion. So I'm going to use that in my valuation. I'll show that to you in a few minutes. I already did it, so I could show it to you. Analysts, 18 of them cover it, and they think, yeah, Intuit is discounted. When we look at a forecast for their revenue growth, they're going to continue to grow. Look at that solid growth. They're going to be a $31 billion revenue company in fiscal year 2029, which ends July 31st. And their profits are going to expand at a faster rate. That looks excellent. So their PE, unless their stock price rises, is going to get into the teens. This is an opportunity. So I like Intuit. I like their brand. Awesome business, good balance sheet. Take a peek at the balance sheet. Always look at the balance sheet just to make sure you're not buying a problem. You're buying an opportunity. Debt is really about a $3 billion debt level. Debt to EBITDA is about 1. So no big deal there. When we look at the value of Intuit compared to its current stock price, it is discounted by 21%. Not the biggest discount you're ever going to see, but you're looking at a very good business, a very essential business that has a consistent growth pattern. It's like a Visa. It's a very good business. So when it dropped below its intrinsic value, I've started picking up shares, and I continue to buy shares in Intuit. I'm glad to see it's rallying after earnings, because this stock, I think, is a good one to have. I'm glad I'm picking it up. It's a real solid company. That is Intuit. They announced earnings. Good things are happening for Intuit. And next one up, let's see here. Bo, making it happen. So Copart's a car auction company, huh? Let's take a look at that one too. All right, Copart. I didn't know that. I just thought they were auto parts or something. All right. So Copart provides online auctions, vehicle remarketing services in the United States, United Kingdom, Germany, Brazil, Canada, United Arab Emirates, Spain, Finland, and they're everywhere. Republic of Ireland, Bahrain, everywhere. All right. $39.7 billion in market cap. They announced earnings. Market isn't overly impressed. Stock's down 3%. What's the market doing for tomorrow's trading? Let's take a peek. What are you going to do tomorrow, market? Oh, don't. Oh, I hope those numbers are wrong. Yeah, they are. Maybe I needed to hit refresh on that screen. Okay, we're supposed to go green tomorrow. And the reason that I wanted to look at that, all right, See, Google Finance is showing me red. Oh, yeah. User error. Okay. So we're supposed to open up green, and I just wanted context, right? Copart is trading down, but the market's supposed to trade higher. So just context, like, okay, well, it's not that the market's crashing again like it did today. Now, this stock here down 27.4, 5-year, it had they went on a nice run. For a while, used car companies were really flourishing. Okay. But those days are kind of behind us. That is behind us. Rear view mirror. Now, these guys they have a PE ratio 25.8. If they're growing, that'd be rational, but we'll see if they're growing. They might have a discount as well. Let's take a look at their growth quarterly. We don't have their latest and greatest quarterly numbers, but we are seeing their full year 9.68. And it looks like for July 31st quarter, they grew at 5.225. Now, the concern there is you see how their rate of growth is slowing. I think that's why the stock sold off so harshly. It's selling off after the market close, probably because they're showing that, hey, either fewer cars are being sold or prices are going down on the services they provide. All that is kind of making their revenue slow down. And slower revenue means you shouldn't have a PE in the mid 20s, because I don't know that these guys make a lot of money. Let's look at their margins. Gross margins are okay. It's not good. It's not bad. It's in between the two, 46%, but the profit margin is good, 35%. Free cash flow margin is very good. So their cash flow rate is very good, but it's a little bit unpredictable. You see some years here, 3.8, 36, 28, 21, 5. It's like, whoa. So, and these are quarters. So when we go full year, let's go full year. So when we go full year, it's more consistent on profit margin and on free cash flow margin. Okay. So they do about $1.2 billion of free cash. Okay. They're not growing really fast, which is, I think these guys would be worth about 25 billion minus debt. And when we look at their debt level, they don't have debt. They have almost 5 billion in cash and just $103 million of debt. So they'd be worth about 29 billion, and they're trading for 39 billion. So no, thank you. The price of the stock's too high. They're not showing momentum in their growth rate for revenue. So it's not like there's positive days ahead. There's actually risky days ahead on a stock that can't measure up if you compare its intrinsic value of free cash flows versus its current stock price. So this one here would be a total sell for me. It would be a pass. I would avoid this one. I wouldn't touch it for my portfolio. So that's Copart. I agree with investors that are selling it off, but there's nothing there for me. NetEase is a Chinese company. They were up earlier. They did announce before the market opened. So on a day like today, for them to be up, the report was decent. Year to date, this is up 50%. Over the 1 year, up 56. Over the 5 year, only up 50. Chinese stocks got beat up about 3 years ago, 4 years ago. They just weren't catching any attention from investors. Investors didn't want to invest in China. Selectively, I did invest in China, and I've done really well. I own Alibaba, Futu, and now I own Sea Limited. This one here is an $86.5 billion market cap company. These guys engage in online games, music streaming, online intelligent learning services, and internet content. So they're a lot like, halfway between Google and Meta. So they're doing all kinds of stuff. And they carry a pretty big market cap. 86.5 is not small. The P ratio for the current year is high, but dropping down 15.8. Analysts think it's fairly priced. They pay a dividend. And let's take a look at what they announced. The quarterly, they had 8.2% growth. This is in the Chinese yuan. It's 0.14 to convert it to US dollars. And if we did that on the fly, we're looking at about $4.2 billion in the quarter. So annualized about 16. So that's a pretty good sized business. It's pretty good sized business. Now let's take a look at their profitability and other things. So they're growing at a good clip. This again is 0.14, and we'll look at free cash flow in a bit. Margin 63%, pretty solid, pretty solid. Profit margin very solid, and free cash flow yield is very good. Now, whenever you deal with an international stock like a Chinese stock analysis, when you go into the statistics, it's going to convert those numbers for you to US dollars, FYI. So you can come here and you can see the cash flow in US dollars is 6.7 billion. Very good. For this type of business with the margins and profits that they have, I'd probably go 20 times this amount. And that would get me to like 135 billion plus or minus debt, because they may have more cash than debt. And they do have more cash, a lot more cash, 21 billion in cash. So they have $20 billion. So this is really a business that's worth like $150 billion, and it's being market cap's 86. So you have a big discount. Now, when you buy a Chinese stock, that's kind of normal. If this business was operated in the United States, it'd probably be closer to 150 billion, but it's in China. So there's different pricing. It's just the way it is. So it's an attractive stock. 5 analysts cover it. They think it's fairly priced. When we look at their forecast, they're going to keep growing, keep getting bigger. They're going to keep making more money, keeping their PE ratio nice and low. This looks like an attractive stock. Looks pretty darn good. Now I'm in Alibaba. I'm good to go. I don't need to invest in NetEase, but this is looking pretty darn good, especially with a lot of money coming out of AI and coming out of that data center. It's going to want to find a place that's doing really well. Maybe Chinese stocks is a place to be. Maybe. I'm going to think about it. Because this one here, they provided a nice earnings report. It's doing great for the 1 year, even pays a dividend. This one looks really good. Making myself a note to come back and look at it again. For all you know, I'll become an investor. Betting, you believe in PayPal? I do as well, but when's the darn market going to believe? We need the market to be a believer, to bring PayPal up to their intrinsic value, because PayPal, geez, they generate cash, they generate profits. The market doesn't seem to be paying enough attention. Look at these cash flows. I showed you Visa, right? The market cap for PayPal is 58 billion. The value of their cash is 172 billion. That's a big, big difference. I showed you Visa, MasterCard, similar business, but different. And PayPal's growing at a decent clip, single digit, but I think 7%. That's not bad for their size business. So this is a really compelling discount, but the market's not buying PayPal for some reason. It has not paid a ton of attention to PayPal, and it hasn't paid a lot of attention for 3 years. Sold it off after COVID, and for a while, it's just bumping along. Just not catching any excitement, no investors. They have a new CEO. And if they can start growing a little bit, somehow grab the attention of the investor, and if they could pay attention to the intrinsic value of PayPal, I think the stock could really move. All right. So, yeah. So China does have some pretty good value stocks. Tencent, it never values as good as I would have liked. And you have to buy Tencent as that one's traded in Hong Kong, China. It's not like an ADR like Alibaba, if I'm not mistaken. All right, Ross Stores is trading higher. They announced after the market closed. This is a discount retailer. These guys are, come on, stock analysis. Stock analysis is getting tired. So there we go. 15% higher, pays a 1% dividend. 45.6% higher over 5-year. So this is going to be this has been a decent performer, not a great performer, decent. And they're probably growing single digit. Yep, middle single digit. This is a good number for them. These retailers, a lot of competition. They're trying to attract customers to come in and buy apparel from their store, and they offer really good priced clothing and items, and it works. People go there, buy their kids clothes that their kids will wear. The kids will look nice, and they get a good price. Overall, they produce good cash flow. I have a valuation on these guys. I'll show it to you. Again, we're down to gross margins at 32, decent profit margins, and decent free cash flow yields. So this one will be a nice stock, for somebody who wants smooth, and that would be the right investment for a Ross investor. James, good to see you. Let me finish Ross, and then I'm going to get back to you. So real quick, so Ross, I have a valuation. I did a video on retailers, and these guys do have their price a little expensive. So this one here is just a pass for me. I can understand people investing in it, but it's not the right investment for me. All right. Good to see you, James. Yeah. So I guess I'm humming along, huh? I got my stride. I'm moving quick. All right. So we covered Ross, discount retailer. They're up for tomorrow. And I think we covered all the stocks. Cool. We covered everything. We got 75 people on the stream. Any last requests? Last call. Ring the bell. Any last requests? While you think about it, if you're a new member, because we've had new members come in, and email me, victorhinvesting@gmail.com. I get you hooked up based on the level you sign up for. For example, I put all the valuations that I work on, all the research, I put it in a shared folder, and you're able to refer to it. So you can look up, hey, I want to look at Microsoft. What's the valuation on Microsoft? Boom, you're on it. It's fairly priced based on my research, just one opinion. You also get access to other things. So email me and I'll get you set up. And I know some of you just joined, so join the fun. Our friends at stockanalysis.com. If you go on my X account, use this link that's provided in the chat, and make your prediction on where NVIDIA is going to be priced at the stroke of midnight on Sunday. Whoever is closest to that stock price is going to get 3 free months in stock analysis. So that should be fun. It'll be fun to see who gets closest. All right, we got a request. Let's look at W. Wayfair. I haven't looked at that one. So we're going to live stream tomorrow morning, Bo, at 9 a.m. Eastern with Daryl. Okay, so Wayfair is a e-commerce company. They do business in the U.S. and internationally. They are really well known for doing stuff for the home. So you could buy furniture there, all kinds of stuff. And for a while, it was quite popular. But the big Amazon, it tends to take a lot of attention away from these companies that are smaller. Wow, 1 year. Holy smokes. I didn't know they were doing this good. Now that's after, we had COVID and everybody was buying all kinds of stuff on Wayfair. This thing crashed down, but now it's been really rewarding the investor that was paying attention. And I am guilty. I was not paying enough attention to this one. This one's just been flourishing. Wow, incredible. They announced on the 28th. And betting you're thinking it's overpriced. Let's take a look. So market cap 12.7 billion, revenues about 1-to-1, forward P 35.46, small discount 9.48. The revenue. So we have a contracting business. Let's take a look at the quarterly. But if we look at the quarterly a little closer, we went from contraction to expansion. And that's what the market's excited, especially this 8. Looks real good. So they're heading in the right direction. Their catalog, the way that they're doing things is looking better and better. So these guys are driving free cash flow. Gross margin is low because they're e-commerce. Free cash flow margin's low because they're e-commerce or reselling stuff. They don't get to make a bunch of money on a resale. Now, these guys are growing now. I would say I'd probably want to pay 25 times their free cash flow rate, and that's going to get me to probably 11 to 12 billion plus or minus debt. They have debt of 2.5, so let's call it 9 billion to 10 billion in value, and they're priced at 12.7. So I agree that they're a little expensive. The market's taking them higher than they need to be, and it's just they just don't make a lot of money. So I think the price of the stock's gotten too high. The forecast, 24 analysts cover them, and they expect they're going to continue to grow single digit. Not overly exciting. Amazon's growing faster than that, like 13%, which is incredible because they're massive. And their profit is going to expand real fast, bringing down their PE ratio into the 20s. But it's still a high PE for a business like this that doesn't have a lot of profit and isn't growing overly fast. So I don't know that I have Wayfair in here. Let's take a look. I have like 700, 800 valuations in here. Here it is. Yeah, my instincts were on it. 53% premium last time I valued them. So it'd be a pass. It's gone places, but where I've done well online is Reddit. I bought Reddit at the right times. I'm sitting on a good gain. I'm sitting on a lot of Amazon stock. Mercado Libre, I'm invested there. And I'm good there. And I'm beginning to buy into Sea Limited, which has been really, really good stock over in Asia. They're headquartered in Singapore, but do business in Asia. So interesting. Thanks for bringing up Wayfair, man. That's an awesome rate of appreciation. Congratulations to those that own it. All right. So EMBJ. So EMBJ. Embraer. So Embraer SA, with its subs, designs, develops, manufactures, sells aircraft. Okay. So aerospace and defense for the last 2 years have done really well. These guys are up 64. Wow, look at that. And aerospace and defense is a sector industry that doesn't make complete sense to me. So I don't invest a whole lot in it. P ratio 137. That's expensive. Forward P of 30. And this has gotten to be an $11.45 billion market cap. It started at a low market cap, but it's really gone up. 7.75 billion. It has been growing full year, quarterly, still growing, looking good. And when we look at margins and cash flow, that's usually where I just don't like these companies. But the free cash flow is looking pretty darn good here. So this is almost 5 billion, is that right? So the margins are 18.2, free cash flows 12. So good solid numbers. See how the margins are limited, right? Low ceiling. So free cash flow 4.9 billion. That's a good number. So these guys are worth more than this because 4.5 billion. I'm in disbelief because that seems too high. Here we go. This is the real number. 921 million. That makes more sense. So if you like the business, they are growing really nicely, and you multiply it times 20, you get to 18.4 minus debt. That would be kind of ambitious because their margins are limited. But let's play with that. 18. And we're going to take away debt, see if they have any debt. They have a little bit. So we bring it down to 17 billion. So if you like the business, you're buying a business that can value up to that level. And do we have no analysts are covering the stock? Where are these guys headquartered? In Brazil. Interesting. Okay. So these guys, I mean, you could, based on their cash flow, I could value them at like 18 billion. It's a small aerospace company. They're growing really well. They're down in Brazil. Looks like their product is being sold to a lot of markets. So this one is pretty impressive. Looks good. EMBJ. Impressive. All right. So, Anthony, good to see you. What's my rational price for Astera Labs? So Astera Labs is, I think, worth $123 per share. It's trading at 139. So it's a little overpriced. This stock's a real mover, right? Astera Labs is not going to be a smooth ride. It's going to go all over the place on you. But buying it at the right time is key. This is where I bought, and it's really gone places. It's really come down from its peak. It's down 44.7% from its high that it achieved on September 18th. Since the recent peak, it's down 27%. So this one's been all over the place. And today, it was down 2% because NVIDIA started off the day way high, and then it faded. So this one here followed, and it's down. It's picking up a bit in after hours. This one here, I think if I was, it's so hard to invest in semiconductor right now. What I was going to say was, I'm not going to buy until it hits like $120 per share. That's what I'm going to do. I don't know what you would want to do, but this thing can fly up. The reason I was kind of gun shy about it is this thing can fly up to 150, 160, 200 in a flash. And it's like, oh man, it could have been a good buy, but it could also go down to $100 a share real quick. So this is a high risk because it's a high growth stock, but I think there's a real good business behind it, which is why I'm a stockholder. So that is Astera Labs. Good to see Anthony. Benton, good to see you. All right, guys, let's wrap it up. We've been going for a little over 2 hours. That was an awesome stream. Thank you for attending. We covered 17 stocks. And I wanted to do a stream because the market sold off so harshly. But remember, this is part of the game, right? This is what happens with markets that get a little too expensive. And looking at the last month, we're down about 5% on the S&P. I think somebody said we were down even more on the NASDAQ. We're down almost 8% on the NASDAQ. That's good. That's some medicine that we got to take to get some of these high prices down. And then it's more rational. Okay. Having stocks go up, just because they have a good story, that's dangerous. We're going to end up in a bubble. It pops. We're in a really bad market for 5-10 years. Not good. Instead, let's get rid of some of the euphoria and get to real good fundamentals. Then we all win. We all have nice long-term upward trajectory on our stocks and portfolios. That's better. So let's treat this as the opportunity that I think it is, which is as stock prices come down on these businesses we want to own, it's an opportunity. It's an opportunity for me. I'll be buying more Amazon if it keeps going down, more Meta. I'll be buying more United Healthcare if it comes down. I mean, there's like 20 stocks that I'm buying, and I'm glad to keep doing so if the market keeps offering good pricing to me. So that is it for tonight. Awesome stream. That was a good one. Thanks everybody for tuning in, and I hope you have a great night, and I'll talk to you again. We're going to stream tomorrow morning at 9 a.m. Eastern, 6 a.m. Pacific. If you'd like to listen to Daryl and I analyze stocks, tune in. And let me wish you a nice Friday and good luck with your investments. Take care.